Hello and welcome to this session from Arrow Academy. My name is Frederick Tito, an IFRS consultant at Arrow. Our topic today is on IFRS 1, that is IFRS first time adoption, the standard that is supposed to be used by entities that are adopting IFRS for the first time. In our agenda today, we shall be looking at the applicability of the standard, the scope. We shall look at the objectives. Why was this standard brought to us? Then in a nutshell, we shall give you an overview of this particular standard where we shall give you the highlights of this particular standard. Applicability of IFRS 1. So where should we apply IFRS 1? It is applied in the first set of financial statements that contains explicitly and unreserved statement of compliance with IFRS. So that is to mean those financial statements that you prepare for the first time under IFRS and have unreserved statement of compliance with IFRS. Number two, it's also applicable to the related interim financial statement for that same period on which you prepared your first set of financial statements under IFRS. And it's good to note that this standard contains all transitional recognition, measurement, presentation and disclosure requirements for a first-time adopter preparing the above statements. So now let's look at scope. What is in and what is out of scope of IFRS 1? IFRS 1 standard is applicable to first-time adopters when they prepare their first set of financial statements under IFRS. Now, having known what is in scope, let's now look at what is out of scope of IFRS 1. The standard is not applicable to entities that are already reporting under IFRS when they are implementing a new standard for the first time. For instance, if you are already reporting under IFRS and you choose now to implement IFRS 17, you will not apply IFRS 1 because you had already adopted IFRS 1. Second, a first-time adopter only implements the transitional provisions of a given standard if that standard allows them to do so. So, for instance, if you are adopting IFRS for the first time and you choose to implement to early adopt IFRS 17, you are not allowed to implement transitional provisions of IFRS 17 if IFRS 17 does not allow you to do that. So what are the objectives of IFRS 1? The main objective of IFRS 1 is to ensure high quality information in the first set of financial statements and interim financial statements prepared for the first time under IFRS 1. Specifically, the standard is developed to ensure transparency and comparability on the first set of financial statements. Remember, on your first set of financial statements under IFRS 1, you will prepare 3 sets of balance sheets: the current year, the prior year, and an opening balance for the prior year. And all that need to be transparent and comparable. Number 2, IFRS 1 provides a suitable starting point for reporting under IFRS. And finally, you need to do a cost-benefit analysis to confirm whether the benefits of reporting under IFRS outweigh the costs that you incur as you adopt IFRS under IFRS 1. Overview of IFRS 1. So now let's look in a nutshell what are the major provisions of IFRS 1. And I want to start with retrospective application. This particular standard requires retrospective application of all the standards with exceptions and exemptions. That is to mean that when you apply IFRS and when you adopt IFRS for the first time, you need to apply IFRS 1 as though you are applying IFRS since the time of inception of your company. And that, because it's difficult, you are given some exemptions and some exceptions. Number 2, you are required to implement all IFRSs that are in effect. That is to mean If you had a standard, for instance, IS 16, that was effective from long time ago, you need to apply all such standards and adhere to their provisions. Leaving out compliance with one particular aspect of a standard that is effective will then disqualify your financial statements, and then you cannot say that they comply with IFRS. Next is declaration of IFRS compliance. The standard requires a first-time adopter to declare in its first set of financial statements that the financial statements are prepared in accordance with IFRS. And if you have a set of financial statements without this declaration, then that financial statement is not in compliance with IFRS. And lastly, you need to show the effects of transition. That is to mean you need to comply with the disclosure requirements of IFRS 1 that requires an entity to show both qualitative and quantitative the effect of you moving from your previous GAAP to IFRS. So you need to write, for instance, if you have property, plant, and equipment, and you are measuring it under another standard, and now you are using IFRS, you need to show us how did the figures change, and what is the impact of those figures that changed. Thank you very much for viewing this presentation. We welcome you to our Arrow Academy website, where you can get to choose our trainings so that we can take you deeply into the training on IFRS 1 and all the other standards that are applicable. Thank you.